Good morning, and a warm welcome everybody to, it's my pleasure to be hosting Innerate's webinar on investor strategies and options together with our expert coach, Frederic Daumas. My name is Edward. I work for the European Business and Innovation Center Network, one of the implementing partners of the Innerate project. And today I'll be your moderator. All right, so as for every Innerate webinar, here's a quick introduction regarding the webinar interaction tool. For those of you who are not familiar with the GoToWebinar platform, please remember this is an interactive session, meaning that we look forward to a lively discussion during the Q&A session. And you can send me all your questions, which you can do via the question box that you can see in the panel on the screen. We'll keep those questions and we'll try and answer as many as possible during the Q&A session as a follow-up. All right, so again, we have a packed agenda for you today. On today's menu, we will start off by introducing the Innerate project. And we'll look into some of the different barriers to financing highly innovative SMEs within the European context. Which will lead us to introduce, the Innerate project and also the service platform that is one of the ways in which we can tackle these different barriers. After which our expert Frederic will delve into the investor strategies and options, and we'll look into what types of exit strategies appeal the most to investors. And then we'll have a small Q&A session depending on how much time we have at the end of the webinar, and then a couple concluding remarks on my end if that's okay with everyone. So I hope you're looking forward to today's session. And with this being said, let me introduce you to today's speaker, Frederic Daumas. I'm extremely pleased to introduce you to Frederic. He's the founder and president of Uperion, which is a French-based organization that specializes in B2B innovation investments. Frederic also has a PhD in biophysics and is deeply passionate about the world of innovation and entrepreneurship. Actually, over the course of his own professional career, he has co-founded a total of 9 startups in industries, in medtech, in different industries such as biotech, IT, Industry 4.0, consultancies as well. And actually, on a more personal level, I've been wanting to establish, a webinar with Frederic for quite some while now. So I'm extremely stoked to have him present today, and I'm sure everyone who's joining us today will welcome you, Frederic, and we absolutely look forward to your presentation. So now that we've introduced today's expert coach, let me take a couple more minutes to introduce you to the Innerate project, which is, Innerate is absolutely making today's session possible. So a couple minutes about Innerate. So for those of you who are not familiar with the Innerate project, Innerate is a Horizon 2020 EU-funded project. The main objective is really to drive the move towards the development of a EU financial system in which highly innovative and tech-driven SMEs, so I hope all of you guys have easier access to the right financing solutions required to scale and grow. And in order to do that, Innerate has basically developed a service platform that basically links innovative SMEs on the one hand and then investors on the other hand. And this is done through an objective and forward-looking technology rating methodology. Innerate is being implemented by a total of 9 partners, which you may see on your screen. And on behalf of the consortium, the way we like to describe the Innerate project is that Innerate brings finance to innovation and then innovation to finance. So that is a very brief and nutshell introduction to the Innerate project. Obviously, if you'd like to have way more information about how the service platform can support you and help you access potential funding, more than happy to engage with you on one-to-one basis. You have my contact details at the end of the presentation. But for now, let's move on to and delve into the different barriers that are currently, financing barriers that are currently being faced by innovative SMEs within the European context. All right, so these barriers. So when looking at the barriers to financing these innovative SMEs in Europe, one of the main elements to consider is really the capacity of investors to assess and rate disruptive and market creating innovation. The real question is, why is that, right? So innovations, and this is especially true for innovations in high growth sectors, are characterized by high technological manufacturing and market complexity. And we believe that this sometimes leads to specific innovations requiring both market expertise, but also an in-depth technology understanding. And this can result in some investors not necessarily undertaking these assessments, as they might, on the one hand, lack technological know-how in order to be able to assess if that innovation is going to be the next big thing, but also the time to do so. As you might imagine, to be able to rate an innovation, it definitely takes a significant amount of time, and investors typically won't have this time to do so. So that's one of the barriers we identified within the Innovate project. Second barrier has to do with data, and specifically the data that facilitates the assessment of market potential and also the risks involved with a specific innovation. As you know, nowadays data related to a specific innovation is extremely hard to find, costly to access, and just sometimes missing. Also, data is scattered across the internet or the web and comes in various formats, which sometimes makes it difficult to analyze and examine. Also, data has restrictions or prices imposed on their use, and this is exactly where the Innovate project and its service platform comes into handy and tries to tackle these different barriers that are currently being faced by investors, but also European SMEs. So our concept is very, very simple. We are developing a service platform that is aimed at supporting investors and lenders for screening, prioritizing, and also financing innovative SMEs with great growth potential. So if you're innovative SMEs and have growth potential, Innovate can help you better understand the potentials and risks involved with a specific innovation and the solution you bring to the table, make your prospects clear to potential investors. We want to help you, support you, rate your innovation, which is one of the services that we provide is the deep assessment, in which we really connect you with a pool of experts. So we have around 50 experts with different, obviously, market expertise, and you can basically book a one-to-one meeting with this experts, and this experts will do an in-depth deep assessment of the innovation that you have created, and then we want to help you get easier access to the right financing solutions in order for you to scale and grow. All right, so we have introduced the Innovate project. We've introduced the different barriers to financing innovative SMEs in the European context, and also a quick introduction as to how the Innovate platform can support you in your fundraising. Let us move forward and delve into today's presentation. So Frederic, the floor is yours, but just before that, I will make you presenter, if that's okay with you.
Yeah. Hi, everyone.
All right, should take only a couple of seconds. You should receive the notification now.
Yeah, it is. Well, thank you, Edouard. Thank you for this occasion to speak with everyone, and as you mentioned, to have a very good and very interactive exchange. Well, the session today is to speak about investor strategies and options, but I will begin by changing the title and decided to talk about love. And as you may know, love never lasts forever, and passion dies in the 3 first years, and a lot of marriage dies about 7 to 8 years. And then it's the same thing for investors and SMEs, and investors have to exit. Well, my name is Frederic Daumas, and I will try to explain you and to share with you my experience as a CEO of a company and startups, and also to share with you my point of view of business angel, and found and seed found creator. Then let's go back to the beginning of this affair. Then once upon a time, there is a smart team of work, the people that work hard on their startups, and as many startups, they need to have more money to progress and to build their company. Then they decided to go to pitch, and I guess that a lot of you have already do this kind of exercise, and they pitch again in a kind of manner of kind of belly dancer party that try to catch investors and try to win the pitch competition, meet angels, and then everyone that have already done this kind of exercise is promising that he is one in which angels have to invest in. So this is the point of view of the startups. But in this case, why investors need to exit? Then I would try to see with you the origin of the need of this exit strategy. First of all, I will maybe recall you what are the kind of investors and what are the timing for them to invest in your company. Then, as you may know, this kind of graph, this is a very, very, very common graph that you find in every presentation, every book, and but still true. Then at the very beginning, I mean, seed and start seed level, then you will use your personal saving and you will love money and first investors that are a business angel. And at this stage, the company has quite no sales or a little bit and needs to be accompanied by people that trust in the company more than in commercial traction. And then after you go to your initial growth, in which you can have more business angel and meet your first VC that are early stage funds. And then when you go to the sustainable growth, then you have more or other VCs. And you see that you are no more angel, but we will see that is not really the case for every project. And then one of the exit that could be very interesting for investors is IPO. And we will talk more about this later. So who are there? Business angel are physical person. They are more interested in the team. They like to play with emerging things, emerging technologies. Yes, they expect some financial return, but more than that, they expect fun and they expect to be involved in the operation of the company because they are very often people from the art, people from the sectors the company is playing. Well, they invest their own money from 10 kilo euros to some millions, depending if you are a standard business angel like me or if you are a super business angel, which more often are people that have already had company that have been sold and with a high valuation. Business angels are very early adopters, then they are also high risk takers. And more often they pay high price for fictive valuation. I guess that some of you will react to this assessment. Well, they dream about the incredible exits, not only in a financial matter, but also about famous. I've been the business angel of the Apple company or the Netflix company. It's a kind of dream of every business angel. The counterpart, sorry, is that may be stuck in company for years because they go in very early and then they have to wait a lot of time to be able to exit. And one another characteristic, which is really, really incredible regarding the high level of risk they are taking, that's very often their due diligence are quite inexistent or not really done correctly it's more like a gut feeling after passing maybe 1 or 2 hours with the company. Secondly, you will have VCs, venture capitalists. These are companies that are more focused on financial returns. They may arrive in later stage. They try to avoid highly risky level of project. They wish to have a risk minimized. And the counterpart is that they can invest a lot of money. But it's not really their money. It's some money they have borrowed from limited partners, which are company or physical persons that have a lot of money, and they borrow this money and promise to pay back this money with an interest rate. That means that these kind of investors cannot be stuck forever because they need to pay back limited partners at the end of the funds. They do more serious due diligences about the tech, about the team, about the market to be sure that there are commercial traction. And then you will also face off CVCs, which are corporate venture capitalists. It's a kind of investors that may be focused on finance, sorry, or on strategic returns. They prefer quick wins and try to maximize their rate of learning. They wish to provide smart and strategic capital and are really focused on return on innovation rather than just on return on investment. And more often, they try to integrate the investment activities into the wider corporate innovation framework because they invest the money of the unique limited partner, which is a company that is behind the fund, that owns the fund. They do serious due diligences about the tech and the IP, more essentially because the company that is behind try to buy innovation, try to buy team, try to buy patents, or whatever kind of innovation asset that could be interesting for the company. Then, once we have presented this kind of innovators, what are their expectations if we try to classify them by stage? Well, this is the main problem, kind of alchemist problem or physicist problem, is that you have liquid money, you put this money in a company, then it becomes solid, it becomes frozen, and then you have to operate a kind of magic operation to go back to liquid. And here, this is some data that I have extracted from Crunchbase for 2019 year. And you can say that there's a different stage of exit. The median multiple of investment coefficient that is true, that is observed, and the number of companies that have been sampled to obtain this coefficient. You may see that seed angel may expect approximately 15 times their initial investment. It's quite normal. They invest at a very early stage with a high risk, so the risk is paying back very well if you succeed. At the early stage, I mean, you have still seed angel, and you have also first VCs, then you will switch to a coefficient of 5 times your investment. And when you go further and further, and as already mentioned, when you minimize the risk, that you have made the proof of the market, then you will have more 5 times your investment and then 3 times your investment. That means that, yes, this is a kind of commitment that you shall exit. And I assure you, this is a fake reference, but it's kind of in the Bible of investors. Yes, you have to invest to make the company grow, and then to sell, and then to go back to investment, and so on and so on and so on. So what is the theory about exit strategy for investors. Well, it's quite simple. This is the different scenario. The first one is the shutdown of the company in which you have invested. Well, it's approximately more than 50% of the case of investment. I mean, I put my money in your company, and then I have a chance on to that the investment turned to a kind of gift because it is lost for me, maybe for you too. But it's an exit scenario. It's a kind of exit scenario that we will try to avoid. But we know that over 10 companies in which we invest, half will die. One will maybe be a kind of unicorn, even I dislike this term. And the other one will just struggle and have a very normal activity, no more than the mean, and you may expect to have your money back, maybe plus a kind of minus money. The other strategy of exit is the IPO. I mean, the initial public offering. In this case, the company in which you have invested is going to stock exchange, and then public people, public person can buy this share, and then it's the occasion for the founder, for the investors to sell shares. This is very particular because very often you are not able to sell all your share, because if you sell all your share, you will you will generate a decrease in the value of the company. Another exit scenario Another exit scenario is the acquisition. I mean, by this way that your company is bought by another one, maybe a big player in the sectors, and then in this case, it can be fully bought, sorry, and all the shareholders can sell their share. And the last one is the buyout. I mean that you buy the share acquired earlier by your investor. Is the first scenario for buyout, but it can be also investors that buy the share of all the others shareholders. In this case, it could be done using LBO, where the fund use debt to buy this. It is mainly the case when the company has a very good cash flow and cash, which is coming over and over each year. I mean, this is kind of very good investment, and then you don't want to sell your share, but you want to have more part of the cake. So what are the reality about exits? I have composed some information for Europe with the from the PitchBook company. So this is the year-over-year investment, and you can see that for the last decade, we are in the kind of exponential growth of investment. I mean, I know that some people are just saying that there's less investors. No, there's more investment than ever from the last 10 years. As you can see, the number of deals has been multiplied by more than 4, and the deal value has passed from 7 billion to 42 billion, so approximately 6 times higher than 10 years ago. Now, if we deal with the exit for the same period of time, then you can see that there's not so exit than maybe expected. We have a kind of peak in 2018, but for the other time, this is a kind of same level since 2014, which is around 20 billion in value. And if you look at the exit count, we are approximately between 60 and 600, and 700, which is quite higher than 10 years ago, because 10 years ago we were at 300 deals. I mean that we have multiplied by more than 2 the number of exits for a multiple of value, which is approximately 3.6 times the exit value that we had 10 years ago. Now, if we look to the sectors, the exit by sectors, you can see that during the last decade, the main exits were in software, in biotech and pharma, but what we can see is that there is a kind of pandemic effects that slow down software exit, increase the biotech and pharma exit, and all the healthcare products or services, but also cybersecurity and e-commerce. These are the big players, the big winners, sorry, for the last year. And yes, I guess it's time to take profits for some, because it won't last ever, as I mentioned at the beginning. Then, if we look at the exit by region, then we can say that for the last year, 2020, the most liquidity are generated by, at the first place, Germany, Austria, and Switzerland region. We have the emerging of Central and Eastern EU, which was not so common for the last decade. And we still have UK and Ireland, which are a good region to make exit. As you may see, there are also, during the past decade, France and Belgium and Luxembourg that were a good area for the exit. Now, if we look at the exits, by type, well, as you mentioned, there are theoretical scenario, but also practical fact that the first exit option is acquisition. It means that in this case, the investors have the ability to sell the whole total amount of share to a new company that acquire your company. And as you may see, buyout and IPO are quite a phenomenon. This is less, very less percentage of the deal. It's a kind of constant for the last decade, as you may see on the graph. So we arrive to the last part of this talk, that is how investors prepare their exit. And I should say when investors should prepare their exits. Well, exit strategy has to be prepared at the entrance. And the first means of doing this is doing and negotiate the shareholder agreement. During this negotiation, investor will try to gain some advantage like board control. They will ask to be on at the board, at the advisor board table. They may negotiate a veto right. For example, you may have veto right to sell IP or to do some acquisition or to sell some strategic assets. They may also have redemption rights, drag-along rights, tag-along rights, and even sale mandates. We will look at this kind of option further. But for the moment, I ask you to do not be in confusion between shareholders agreement and investment agreement. This is two kinds of paper that are barely different. I mentioned redemption right. The redemption right is a feature that allow the investors to oblige the funders to repurchase their shares after a certain amount of time. It could be at the price of the moment, or it could be in a range of price that have been negotiated at the beginning. This can be seen as a security for the investors. I mean that if the company do not reach the goal in 5 years, then the founders agreed to buy the shares of the investors. Well, in the real world, it is very difficult to operate this kind of clause, because if the company didn't reach success, then I bet that the company and the funders do not have the money to buy back the shares of the investors. And then you have a lot of company that are kind of zombie. This is Walking Dead. They are just struggling. The investor are stuck, and nobody can buy the share for the investors. This is a very terrible use case, but this is very, very common use case, in fact. The drag-along rights is a clause that enabled the majority of shareholders to force the other one, the minority, to sell their share if there are a good opportunity. It means that the minor guys cannot say, I don't want to sell my share to this company because there's a company that want to buy your startups. Then all the investors says, no, you are forced to sell with us. And very often these rights are also connected with tag-along rights, which kind of co-sale rights. I mean that if a majority of shareholders can sell, then the minority is able to sell too in the proportion of their participation to the company. So the kind of equality, kind of finding a way to be more equal than if you have just drag-along rights. It's why investors want to have drag and tag-along at the same time. And sell mandate could be very difficult for some funders, because then in this case the shareholders agreed that maybe in 5 years, if the investor find another company that is able or interested to buy the company, the startup, then even if the funders do not want to sell, then the investors are able to sell the company to another one. So it's really complicated when you have this kind of rights in negotiation for shareholder agreements. But you have to understand that once investors have put money in your company, very often the founders, because I mentioned the belly dancing stage is finished and you have the money of the investors, then you use the money to develop the company, you use the money to pay yourself. So you pay the work and you don't pay the investment, the capital. Then you have to consider that it's normal that investors should be paid too. So very often, one of the advice I give is, if you don't want this kind of thing, maybe you can add some rights to dividends, and maybe say that in 4 years, if the cash flow the company allows it, then the company will pay dividends to investors in priority. That will help you to avoid this kind of Selman debt, for example. They can also prepare, they exit by choosing the right tool they will use to invest. Well, this is not the shareholder agreement this time. This is for the investment agreement, which is the contract by which the investors explain you what kind of money will bring to your company. The most common is pure equity. Even if you may have a different category of shares, they may have shares with a lot of more than one voice when you vote, some share with no voting rights. This pure equity in this case, and you may have safe and convertible bond or convertible notes. I would just focus on safe. Safe is simple agreement for future equity, and it's a promise that in exchange of some funds, the investor will have right to receive share if the company reach a kind of breaking point or a special event. Could be, for example, that the company is bought by another one, or reach a kind of market traction and so on. So in fact, it's not so simple for investors, and it could also be a trap. So I'm not sure it is the right tool, but if it is the right tool for you, then investors have to be backed by good lawyers to put a good definition of the trigger event in a realistic manner. You have also another focus on convertible notes. This is very interesting because it is used a lot for the last years. It's not equity, it's a debt. And as a debt, it can be reimbursed, and it will have an interest rate, usually around 8%. That means that each year, this loan will generate 8% of interest that you have to reimburse in plus with the capital. And it has the possibility to be converted in equity. And in the case of conversion, well, there is a kind of discount, which is not a kind of discount. This is a discount, sorry. This is a discount which is agreed at the first beginning, at the moment when you sign the contract, on the price of share. For example, with a 20% of discount, that means that if in 4 years I decide to convert my debt, my loan, into equity, I will not pay the share, the full price, which could be €1, but I will pay them 0.8 euro. And as an example, I put you the case of an investor that I've put a loan of 300,000 euros, and at the very early stage, and at the Serie A stage decided not to be reimbursed, but to change the share, to change the loan into shares. Then you divided the amount of invested at the early stage by the price paid by the investors. I mean that then you have to 375 shares there. But in this case, this is not so interesting for the investors if the Series A is a kind of home run, because it will have the same amount of share independently of the valuation of the company. Then it could be, in my case, for example, may have 35% of the company or just 3% of the company. That's why very often investors use valuation caps. I mean that even if you do 10 million valuation, they ask for the same percentage as if you were at 1 million of valuation, because the valuation caps is 1 million for them. Then I will conclude at the concluding tips. Well, my first tips is do very well due diligence about your investors. You must look at his portfolio. You must call CEO of company that he had invest in to see what kind of investment he has done, and then you have to negotiate your shareholder agreement. Please use a lawyer. It's a kind of mess if you do not do this. And try to pay back early investor very early, pay dividends, and be cautious with your valuation. Could be a trap for you for the next round, and could be dramatic if you have to explain to investors that the valuation is not the good one, and that you have to decrease the valuation. Well, that's all for me. Hope it will we will have a good Q&A session now.
All right, many thanks, Frederic, for this really enlightening presentation. I'm sure everyone will join me in thanking you for all these tips and tricks. Obviously, I'm conscious of timing right now, and I would really like to give everyone present today the chance to ask questions. So if everyone's okay with it, let me kick off the Q&A session. So I will take, see that we've received quite some questions already, which is really, really fantastic. All right, good morning, Frederic. An excellent insight into the world of investment and exits. But the consideration of exit would have to go back to time of investment. The 3 to 5 or even 7 to 8 would be the point of investment, which lead to the exit points. So the question is, so would we consider the level of investment as being positive? As being positive a number of years before, as opposed to when the exit occurred?
Just to be sure, because I don't see the question on my screen. Is there a way that I could see the questions?
If you maybe go into the questions and answer, or the question sections on the panel.
I just have the chat.
So maybe you don't have. Let me just try and repeat this one.
Yeah.
The 3 to 5 or even 7 to 8 would be the point of investment, which will lead to the exit point. So would we consider the level of investment as being positive a number of years before, as opposed to when the exit occurred?
Well, I try to understand the question, and I think that the main problem is, yes, the time for the investors. It's not really depending on the amount of money. It's more depending on the stage in which you are investing in. For example, as the business angel, are really invest earlier in the stage as a seed, for example. And I am, for example, in I have invested in approximately 10 companies, and the one I'm stuck longer is 11 years now, and it's a company that is has a very good activity, and but the guy doesn't want to sell the company, and he's still developing the company, and then he pay back dividends. That is more better for us, because year over year we have be refunded from our initial investment. So what you have to consider is that investors are at least present for 5 to 8 years. And it is why we often ask you to do financial forecasting for 5 years, even if I know that you are not able to have a good vision more than 2 years, and then everybody agree that from the 3rd year to the 7th or 7th years, then it is just a kind of wish better than reality. But we want to see how you consider that we can exit and how we can do our job of investment. Okay, and to complete my answer, I think that another mistake is very often people think that seed investors, for example, will be able to go out for Series A when the other investors will go in. And then this is not true, because the new investors don't want to pay for the former investment to leave, because they know that the company needs these funds to grow, not to pay investors. So this is kind of a situation that you will have to face off very often. This is why very often seed investors prefer to have convertible notes or convertible bonds, because it's debt, and then it's more acceptable for the new investors that the company sold this debt.
All right, thanks a lot, Frederic, for this detailed answer. Moving on to the next question. So what kind of exit strategy would you recommend for a seed stage startup developing e-health tools, which may be reimbursed by healthcare insurance?
Well, healthcare is maybe the more complicated because it's very often more longer than software company, but the valuation is not the same. For example, I'm founder of medtech company, and at the very early stage, with a product that just demonstrates that it was able to do what we planned, but not a good prototype, then the valuation was maybe 10 times than a software company at the same stage. So the only, for me, but this is just my point of view, so maybe not the truth. My really interesting exit is the acquisition by a big player. Why? Because when you, for example, if you develop a medtech device, then you have to obtain all the agreement, FDA agreement and CE mark and so on, and you know that there is a lot of classification. You have to do some clinical trials and so on. It costs a lot of money, and I think that well, my strategy was always to bring it in kind of secrecy, and to find maybe the big pharma that will be interested by the product, and then will be able to buy the unfinished product. Why? Because they have the ability, they have the finance to pay for all the full clinical trials. They have the right people for the industrialization. They have the right people for the distribution. I mean, they can do lobbying, for the medical doctors and for the physicists and so on. So they master this very well. Very often they do not really master the innovation as simple than young company. But I don't think that IPO strategy could be reasonable for this kind of I think some arrives, some succeed in this, but I think it's really small percentage. So acquisition, yes, this is my answer.
All right, thanks a lot, Frederic. All right, we have quite a specific questions next. So if you were to invest in companies in Eastern Europe, how would you go about due diligence and make an exit strategy? I know this is quite a specific geographical sort of question.
Yeah. Yes. Well, concerning my side as business angel, I have few rules, and I try to follow them, but sometimes it's difficult. Well, the first rule is I invest in company I understand. This is first thing. So I am biophysicist. I like digital things. I like IoT. I like biotech. So I just focus on this kind of investment because I am able to understand the market. I am sometimes able to see evolution and connection in another way than the founders, and then well, it's quite good. I've done some investment. Well, I'm not French, so I do a lot of investment in France because my due diligence are more simple. In this case, I've done some investment in Ireland, so it's a country that I know well. When you go to another country, you have to understand also the fiscality of your trade. You have to better understand kind of regulation in this country, and sometimes it's simple and sometimes it's difficult. I guess France is one of the most complicated country, just after Brazil. But I guess that in some country is totally different. Well, I just recommend to invest in things that you understand and think and country that you know, or maybe that you have connection that explain you what are the deals in this country.
Okay, that makes a lot of sense. Thanks a lot. Just before we move on to the next question, I would just like to highlight to all the participants that the session has been recorded, and we will make sure to send you a link so that you can go and rewatch it, where you can access also the slides and the webinar as a follow-up. So no worries on this end. All right, so we have another question from Peter. In my mind, management is in a company is key for the exit process. If you agree, would you mind commenting on how management should be incentivized to maximize chances for a lucrative exit?
Well, yes, you're totally right. I think that the best way for the founders is to take the action of this kind of exit. That's why the first step is when you prepare your pitch and when you explain the amount of money that you need, and when you break down the usage of the funds, then it's really useful to explain your vision. And for example, if I go back to my own investment, for example, in IoT for industry, then the company explained that yes, it will be try to find exit for the company, and the exit for the company mean also that there is an exit for the shareholders. And as investors, you are shareholders. So when the management show you a clear vision, even if it's not really the truth that what happens in because it may be in 5 years, and nobody can predict some events as we may live today with the COVID situation. This kind of situation that are not possible to predict. Then yes, you have to deal with. But in the case where management explained that yes, we will try to sell the company to another one because of many things. Maybe the distribution network is more difficult to build from scratch, and it's more easier to go to a big company. And then yes, you gives a kind of insurance for the investors that you will do your best to find a way for them to exit. This is very, very, very good and clever situation. And I still think that acquisition is still the more reasonable thing that people may understand, because the fact that what I show you what I've shown you is not projection, is the real statistics. So investors know about that. But you may say, yes, I will buy out your shares, but then you have to show that you have some spares to show the share. But I'm not really comfortable with this kind of exit strategy. Yeah.
Okay, thanks a lot, Frederic, for all this detailed answers to the Q&A session. We've received quite a lot of questions, and unfortunately, this is we won't be able to cover them all during this webinar. What I can suggest, depending if Frederic is okay with it, maybe I can put some of you in contact with Frederic as a follow-up.
Sure.
So that you can, maybe connect with Frederic and then ask all your relevant questions there on a bilateral basis. But unfortunately, I will have to conclude this webinar. So yeah, I think the first thing is obviously to thank you, Frederic, for taking the time to really give us a really strong presentation about exit strategies. Definitely something that is extremely relevant and very, very interesting. So thanks a lot for taking the time. And then a massive thank you to all the participants for tuning in today. I hope you enjoyed the presentation, and I look forward to connecting with you in other webinars as well. And talking about other webinars, just a quick slide here to mention that Innerate has established a collaboration with the European IPR SME Help Desk project, which is a project that provides free services in terms of IP protection to European SMEs. We will be organizing a webinar on the 6th of May on innovation and IP commercialization and licensing. Obviously, IP is an element that is quite complex to understand, but is crucial when you're raising funds for investors. So we will be benefiting from experts from the European IPR SME Help Desk. So we'll send you a follow-up email with some links to register for this session as well. And obviously, we've got a lot of more webinars and workshops, pitching workshops that will come soon. So you'll hear from us. I look forward to connecting with you in the framework of another webinar or workshop. And on this note, I would like to wish you a real fruitful day ahead. Thanks a lot.
Thanks.
And see you soon.